everyone, welcome back to Invested, where we talk about wealth as being more than just money. Our partners Paul Rand, Joel Rand, and Sarah Minikari will bring in guests and industry thought leaders to chat about meaningful topics on personal finances, health and wellness, ideas for your business, tax planning, and other key issues that impact our lives and our livelihood. So thank you for joining us, and we hope you find our discussions not only practical and educational, but maybe sometimes a little thought-provoking. With that, let's get to the episode.
Hi, and welcome back to Invested. In this episode, we continue our exploration and explanation of alternative investments. Today, we will talk about private debt with Alex Wright from Apollo Global Management. For those unfamiliar with Apollo, it is a leading provider of alternative asset management. It invests in both private and public markets across the full spectrum of credit, equity, real assets, and including infrastructure. Apollo was founded in 1990, and its asset management division now has over $650 billion in assets under management across various strategies. Alex Wright, our guest today, is a partner and global wealth strategist in the Client and Product Solutions Group at Apollo. Previously, he was the co-head of Yield Products and a portfolio manager for Apollo's closed-end funds, CLOs, and private BDC. Prior to joining in 2011, he was with GSC Group, where he served in various roles, including Chief Administrative Officer, Chief Financial Officer, and Head of U.S. Corporate Debt. Alex graduated from Rutgers College with a BA in Political Science and a minor in Economics, and he earned his MBA from Fordham University. Alex serves on the Fordham University President's Council and the Alternative Investments Senior Advisory Board. We hope you enjoyed today's discussion, and as always, feel free to email us with any follow-up questions you may have on the topic, or let us know about additional topics you would like us to cover on our podcast. So with that, we are joined today by Alex Wright from Apollo. Alex, good morning.
Good morning.
Or good afternoon your time, I guess. Good afternoon. Sorry. So as we talked about, this is part of a series we're doing on kind of explaining to people about private markets and just that stuff that goes in that bucket of alternatives. And in private markets, we've talked a little bit about, we had an episode on private equity. We had a sort of a general episode on alternatives all as an overview. But today we kind of want to dig into private debt a little bit, private debt, private credit. Ask you if there's a difference between those two words, and then just talk about the structure with that. So thanks for joining us. Appreciate it.
Yeah, thanks for having me, and looking forward to the conversation.
So I guess, let's just start there. What is private credit / debt? How does it work? How would you describe it in general?
Sure. So I think most people think of private debt as middle market direct lending with sponsors backing them. Our definition is quite more broad than that. So simply put, it's debt that does not have a CUSIP or is tradable in liquid loan format. And the definition is broader in our mind as well, given the platform that we're running. It goes from large asset-backed financing activities to large corporate debt activities. And we view that as nearly a $40 trillion opportunity set, which is far beyond what most people think. Part of the reason we feel that way is, yes, we have corporate debt activities. We've done that for a long time, but the asset-backed arena is one that is quite vast. At this point, if you think about high yield and broadly syndicated loans as a $3 trillion market, asset-backed is many multiples the size of that. And so we think that along all of these different stops on the bus, so to say, there's plenty of different avenues for us to enact private credit activities for a variety of different assets, not just simply corporate debt in isolation.
Yeah, when we're going through and educating clients about private markets, and one of the things that we go through is the sheer opportunity set. When you look at the number of publicly traded companies, and especially those that may be issuing debt, which is a subset of those publicly traded companies, but then all of the private companies that are out there and that they need debt issuance or they need to borrow. And so maybe you can talk about what are some of those kinds of circumstances that would lead them to come to and say, hey, we need some debt.
Yeah, sure. So I guess first and foremost, I would say you could look at the equity markets over the last 10 or 15 years to see how that shift has occurred. There are a whole lot less publicly traded companies than there were 10 or 15 years ago. And within the debt space, certainly we're seeing that trend as well, in the sense that they're going to private executed lenders and activities. So the why would they come to private debt, and what are they using the money for? It's really manyfold. On the asset-backed side, if we think about aircraft finance or credit cards, securitizations, fleet management, financings, those are expansionary in nature. On the corporate side, this can be simple refinancing activity. This could be merger and acquisition activity. It could represent a financing to a financial sponsor, private equity owner, looking to buy a company, and we would provide financing in that format as well. So there's a variety of different reasons or use cases or use of proceeds. The question embedded in that, if I may, would be, okay, well, why not just go to a bank? And
that was my question.
Oh, sorry. Okay, go ahead. You can ask it, and I'll answer.
See, you're just earning the $20 that we paid you ahead of time.
Right, exactly.
To lead us into all the questions.
So with that question, why not go to a bank? There's a few concepts here, right? First is, at a high level, regulation, Dodd-Frank, going back to GFC, regulators are here to protect depositors and taxpayers. And so within the banking system, there has been directionally an increasing reserve requirement for much of the lending activities that they had pursued in normal course over the last 10, 15 years. And as a result thereof, it's really pushed a lot of the activity into investors' hands. It's actually matched better if you really stop and think about it. Yeah. SVB lost 40 billion of deposits on iPhones in 4 hours, and yet they were lending longer term. Having loans and these types of activities in the hands of investors who are buying in, knowing exactly what they're going to be investing in by way of the thematics, is a very powerful and much better matched situation fundamentally. Now, the other thing as to why not go to a bank, there's some complexities with going to a bank. Many a time, the term sheets that will be offered are best effort, meaning those are not done deals until they feel and find out what the clearing levels are in the marketplace. So if you go to a private lender like ourselves, the term sheet is the term sheet. We will close on what we promised to close on. It's not a go test the market scenario for us. And why do the banks have to test the market? Same reason I just gave with regard to reserve requirements. They do not want to end up having the exposure on their balance sheet. They want to underwrite a new loan, sell it into the market, and then trade it and clear it off their balance sheet and then do it again and again, which is a nice business for them when it works that way. But it is a simplified approach, if you will, by going the private route as compared to the banking route.
Yeah, I was going to say, is there a layer of speed being a factor? And then also in terms of what has to be disclosed, I would imagine what you have to disclose to a bank may be different, perhaps.
I would say the depth of the diligence is quite similar, if not deeper, on our side, because we're underwriting to hold. And in our case at Apollo, these deals actually go in third-party funds, but they're also landing on our own insurance company balance sheet, which is an A+ rated organization. So the diligence and care in which the underwriting is happening is pretty deep. I would say, the complexity of the banks is, yes, they're going to have to likely go to the rating agencies with the management team, get these names rated for purposes of sale into vehicles like collateralized loan obligations. I won't go into all that detail, but typically you need ratings on these. The speed, yes. I mean, we can move swiftly with a lot of knowledge, backgrounds on the companies, backgrounds on the industries, lean on our private equity teams to provide us their insights as well. That's a powerful combination. So there's speed and certainty of close, I think, is probably the message I'm sending, as compared to, okay, bank route, are you really having a fully underwritten deal or not? Do you have to go to the rating agency? Yeah. What else do you have to do? So it's a little bit more straightforward.
I like how you kind of politely didn't come out and say, shh.
Well, we partner with the banks.
Yeah.
So, I have to say up front, it's not a one-way road, right? Yeah. Many a time we're partnering with the banks, we're stepping in, we're taking risks down with them. given our size and scale. So it's it's kind of two shots on goal with a company. Do you want a privately executed transaction, or if you're going to go the bank syndicate route, we can come along as a major anchor.
Yeah.
Help de-risk the bank and kind of help you as a company get to the goal that you're trying to achieve. So it's kind of hand in glove by way of one shot that way, the other shot going the other way, so to say.
And I think there might be, well, you tell me, if we compare and we look at different asset allocations, and as I've mentioned before, a lot of the new clients that come to us, that rarely do they have exposure to private markets, and we have to educate them. But they may say, "Oh, well, is that the same as high yield? And how is that different? Because aren't you talking about smaller companies, and aren't you talking about lower credit quality? So can you kind of compare and contrast that with high yield?"
Yeah, sure. And that's a common question. It's a logical question because that's what most investors are used to seeing and have followed for some time. I would point out some differences that are pretty stark, though. Okay, so first, much of what we are doing, if not all, is going to be senior secured first lien, where high yield is unsecured. That's a big differential. The second is what's the relative value? And ironically, right now, high yield is trading at nearly GFC-like tights, going all the way back, based upon what's happening in the rate environment. Trading inside of a 350 spread. I saw yesterday double Bs are trading in the 160 spread to treasuries. These are awfully tight levels. In comparison, the last 15 years, high yield's traded at about a 530, 535 spread. So I think there's
meaning the increased return you get over
treasuries.
Yeah, right, exactly.
Yeah. So I think fundamentally right now, that's a pretty tightly priced market. And I think one directionally that it's going to start moving out.
Yeah. So before with a tighter spread, you're less compensated for taking that additional risk, right?
That's
before
right.
you had more compensation. So why take that additional risk if you're not getting additional compensation? And
that's exactly right.
And just to clarify on the first lien position, can you just define that just quickly so everybody understands?
Sure. So first lien senior secured means that if in the event of a bankruptcy, you are going to be the recipient of the first dollars coming in once they have to pay taxes or this kind of stuff. But you're the first in line on the creditor line to be repaid. And so traditionally, your recovery rates are materially higher if you do run into a problem.
Interesting. Let's go through the different types of private credit: direct lending, infrastructure. The list goes on.
Sure. So if we start with corporate lending, just out of the gate, here I really describe this with three segmentations, right? Sub 25 billion EBITDA size companies, 25 to 100, which is a traditional US middle market, and then what I'll call mega cap, which is really where we spend most of our time. We average about 250 million of cash flow size companies, so substantially bigger. And that's by design. Fundamentally, we think there's more financial flexibility with the larger companies, more downside protection, larger equity checks in those capitalizations from the owners fundamentally. So that's where we like to deploy, if you will. If you think about infrastructure finance, you've got a lot of wind at the back as it relates to, quite frankly, public-private type considerations with Infrastructure Act money and so forth, and obviously a long, long runway ahead of us to deploy that money into very interesting risk-adjusted return applications. The asset-backed arena is much, much broader. Okay, so one would need to ask themselves, okay, where do you live? Do you have a mortgage? Okay, well, the mortgage is a form of asset-backed financing. Do you use a credit card? Okay, you probably do. You can securitize credit card receivables, and that's an asset-backed oriented financing. If you think about, how'd you drive? Did you drive to work? Did you rent a car? Fleet leasing, another form. Okay, aircraft finance. Have you flown on a plane recently? Most likely that has had some form of asset-backed financing for the carrier to buy the planes. The list can go on and on and on. Student loans, another example. So there's a variety of just everyday life activity in which you guys are all touching some form of asset-backed financing. And that is an area in which we've been very active over the last 15 years, in fact, investing north of 200 billion into these types of activities. So these are very resilient if you do them correctly and pick the right assets in a defensive manner. So it's a very broad opportunity set, I guess, is what I'm getting at. And it's a matter of, what manager, what type of infrastructure have you built to address that? In our case, we've formed more than a dozen operating companies that are generating these types of assets. And that has been built out, again, over a 15-year time period. So it takes time.
Yeah.
But once it's up and running, it's well positioned to provide very interesting risk-adjusted returns.
And I don't want to get too far in the weeds, but you mentioned loss rate a couple of times. And one of the things that when we're interviewing managers in this space, a lot of people talk about their deal sourcing. In other words, the amount of research they do on the front end of the loans. But then the loans are up and running. And sometimes the companies, you are taking a risk, and sometimes the companies may run into some headwinds, and there may be defaults, but there's also a workout process that I think a lot of people don't know that it exists. They kind of think, oh, if you can't pay, then that's it, you default, and that might not necessarily be the case. Can you just talk about the workout process and what that means?
Sure. So, a very good point. If there's a default, that does not mean that you're automatically going to lose all your money. When there's a default, you're going to have a very deep conversation with the owners of that business. And that then takes the form of what we call a workout, which is really a negotiation to restructure the company. Now, you could do that inside of bankruptcy or outside. Much of it is done outside of bankruptcy, quite frankly, depending upon the severity of the problem and the cause of the problem within those companies. So some things that you do upfront that can assist you in maximizing your recovery value would be putting in financial covenants or other covenants to protect you in the documents. So those would monitor the business, monitor the leverage, monitor their ability to pay their principal and interest. And those metrics have predetermined levels that you set. And if they break those levels, that's when it'll trigger a conversation quite quickly with the owners, hopefully catching it well in advance of any form of true payment default. Okay. And that's going to trigger waivers, amendment discussions. Maybe you extend maturities. Perhaps you could give them some payment relief. You could insert some paid in kind interest, which is not cash interest, but it increases the loan over time, but it gives the company some breathing room to get onto the other side of whatever the situation is. Or you speak to the owners about putting in more money to right-size the capitalization of the company. Yeah. So there's a variety of different levers. There's a variety of different protections within documents that you can enact along the way to hopefully work with the ownership group, trying to protect the creditors as their number one goal, which is sometimes, not the case, but many a time that is their fiduciary responsibility.
Yeah.
And so there is a combination of that. Now, it's very important when you're thinking about what manager to choose, though, because some can raise money very well and some can lend it out, and that's fine. But the depth and breadth of the workout and restructuring capabilities are vitally important if and when you go into a deeper part of the cycle. So, at our firm, obviously we have some 300-400 people within credit. We have a whole group that is workout restructuring that we can tap into. We have industry analysts that all they do is cover these companies top to bottom. And if we have to, we could create SWAT teams to pull in more experts, whether those be some of the executives that have run some of the private equity companies that we've owned and operated over the last 35 years, or tapping the partners in private equity to talk about crafting what will this workout restructuring look like to protect our investor capital as we sit on the top in first lien format. So having, sort of that arsenal, for lack of a better description, at the ready at any point in time with that type of depth really does protect the investor base.
What are some of the other risks the team is looking at as it relates to private debt investing? Like what's keeping the team up at night?
So certainly credit selection is paramount. Okay. And I think part of the benefit of some of our activities are started, here in the last couple of years. And so the vintage really matters a lot. Okay. Because if you go back a little over 2 years ago, it doesn't matter what segment or who the manager was. They didn't know two things fundamentally. I don't think anybody was anticipating 9% inflation. or the stickiness that we find ourselves in today, even at these elevated above 2% levels. The second thing that people didn't know, and that's for darn sure, is that we just incurred a 500 basis point increase to base rates. And so the debt service that was anticipated is nearly double or more than what was anticipated. And so anybody that has a fund that's 2, 3, 4 years old, they're finding elevated loan to value levels. Okay. They had to go through, those cash flows had to go through the realities of inflation and try to keep up with this debt service. So that's where you're starting to see some cracks forming. The new vintage, the 2 years or younger, what I would call the toddler, group.
Not the newborn, the toddler.
Newborn to toddler, but really toddler. We've seen some very positive developments. First, loan to values have come down quite substantially. In corporate land, you're looking at loan to values as low as 40% compared to historic norms of 60 to 70 or higher. So that's really allowed those vehicles to keep interest coverage ratios of 2.4 times, very robust. And you've had the ability with the newer versions to steer away from the industries that are most impacted by inflationary realities, or where the economy has softened up somewhat. Okay, so you're kind of able to steer away from some consumer, some of these healthcare roll-ups or dental roll-ups, which is some of the areas that we've seen some pressure, commodity-oriented businesses that have heavy inputs. And so you can create more defensive portfolios with that knowledge. Sort of you're kind of sitting as a Monday morning quarterback in a way, analyzing the game through the lens of, okay, what happened to the cash flows of this company in the last 2 years with inflation? So it's just a better seat to be sitting in fundamentally.
With and you mentioned a lot of different industries, but can you give us an understanding of some examples of how do companies use the money that they borrow? What are some sort of typical examples, and how does it work?
Sure. So we just did a refinancing transaction for a company that is involved in scholastic sport uniforms, yearbooks, cheerleading camps. It's a large company, nearly 350 million of cash flow. And so they were looking to do a straight refinancing. We provided them $450 million, first lien, senior secured at SOFR plus 600 with 1.5 in fees. And we structured it in a way where they're not allowed to repay it for the first year and a half. And if they do inside the 3-year maturity, they have to pay us 3% in prepayment penalties. So that was sort of a refinancing concept. Similarly, we did a refinancing recapitalization for a large private equity firm that owned the leading bankruptcy software company. Now, again, counter-cyclical, kind of interesting, right? We've had a 19% increase in bankruptcies here in the last year or so. But what this company does, very interesting, 2 lines of business. They maintain the databases for the trustees, and more importantly, 85% of all bankruptcy attorneys use the software for case preparation. So they have maintained a 99% retention rate of those folks. So in that case, we ended up doing obviously a first lien senior secured transaction, and we received SOFR plus 600, again, a couple points in upfront fees, and this was done at a 37% loan to value. I'll give you one last one. There's a company in the EV manufacturing arena that needed expansionary capital. We had looked at that through the lens of a participating preferred issue, which is kind of drifting into our private equity arena. But both of us in the company were like, we're not sure that's the right fit. And so we pivoted and provided them with a senior note issue, which was priced at 9 7/8% fixed rate coupon, but it was non-call over the first 3 years and then very serious prepayment penalties in years 4 and 5. So I think, the message here is you want to get paid, you want to protect the repayment risk fundamentally, but we've seen a lot of interesting areas to be deploying capital, and many of them are kind of counter-cyclical. Like you're not going to fire your yearbook provider at the high school, right? I mean, where's the caution?
I got a bad headshot maybe, but
well, yeah, that's true. But no, you want to be cautious with commodity-driven businesses, the cyclicals right now, consumer, because at the middle and lower end, you're starting to see some buckling, auto loan defaults, credit card defaults. So you need to be thoughtful and be watching the macro as well as the micro.
I mean, on that front, the private debt market's grown, sixfold since the global financial crisis? It's grown quite a bit. Has the regulatory environment changed? Well, I would imagine it has, but to what degree?
So we do get this question often, and I would say we're not systemically important yet. Okay. So if you think about some of the larger private credit managers in corporate land, if you add them all up and all the big names, you won't even reach kind of 100 billion. And so relative to the high yield market or the loan market at 3.1 trillion, there's a lot of runway ahead of us. And so the growth rate certainly has increased pretty well from a percentage perspective, no doubt. Even in absolute dollars, I guess you could make the argument, but there's a lot of room to go. And frankly, the regulators are promoting that to happen. Right? I don't know if you remember.
Better balance sheet for it to rest on.
Increasing reserve requirements, pushing this type of good lending into the hands of investors, which in our view is a little bit more appropriately held. So look, for us, where we sit, certainly the SEC governs us, as a publicly traded, registered investment advisor. Having the largest fixed annuity insurance company merged into Apollo, the insurance regulators also are reviewing what we're doing with a very close eye. So I feel like there is ample regulation, but really, again, the regulation at its core to date has been to protect depositors and taxpayers, neither of which we really have, given the form and function that we are performing our business with.
And going back to we've gone through some of the benefits of there's higher rates, and we haven't touched on the volatility so much, which it's generally less than publicly traded markets.
Yes.
If you want to touch on the mechanics of that, that's great. But also maybe let's talk about the role liquidity plays and maybe how those two things intersect and what investors should expect from hey, how liquid is this? If I invest, when can I get my money back? And how the mechanics of that and how that plays into volatility if you want.
Sure. So a few things to unpack. So first, I would say don't conflate liquidity with safety.
Yes.
Okay. You've seen the significant volatility in many of these markets, and the concentration within these markets, particularly the equity market, is like nothing we have seen before. And the one question you have to ask yourself as I make that comment is, who's on the other side of that trade when you need the liquidity? It's there on the way up in two-way, what I'll call two-way trading format. But when it's on its way down, beware, because the elevator doesn't stop at every floor. Mm-hmm. Because those that are coming in to buy will be folks like ourselves in our opportunistic credit business, where we're going to be downbidding very substantially these types of assets. Okay. And so just be mindful of that. We have billions of dollars at the ready at any point in time for purposes of deploying into the liquid markets when ETFs, open-ended mutual funds, are under massive redemption pressure. And again, that's not a par bid. That's going to be much different than that. So, as that relates to private markets, there is more stability fundamentally in private markets, partly because they're not subject to the inflow-outflow data movements. Okay, if you look at high yield as an example, some of our founders would say very difficult to drive alpha as a bond picker in this type of market, because you could select the best set of bonds, but if outflows happen and there is a risk off and that stuff starts getting sold out, okay, again, opportunistic buyers like us come in, the market comes screaming down very quickly. This happened summer before last in the liquid loan market, actually. You had a risk concern that kicked in post a duration concern. And not to get into the weeds too much, but CLOs, which are the institutional loan buyers, if you will, from banks, the arbitrage inside those vehicles collapsed. And so a lot of the demand came offline, and the loan market traded from 99 down to 91 very swiftly. partly because, folks like ourselves were bidding down at those levels.
Meaning pricing at 99 cents on the dollar versus 91 cents on the dollar.
Correct. But I'll give you an example. We had a business, a securities oriented business, the folks in the blue jackets checking you into the big office buildings. Okay.
Right.
That company traded from 99 down to 94, but that same quarter, their cash flow was up over 20% and they delevered. So does that make any kind of sense? To me, it does not. And if that was in private format, the independent valuation firms would have looked at that for the metrics of the company itself. What's the leverage? What's the coverage of their debt service?
Yeah.
All of those aspects were actually improving. Now, that's not to say they would have marked that up in value, but they definitely would have maintained its value. And so there's a bit more objective performance related to how things are done on the private side. Now, one needs to be a little bit thoughtful around, I don't want to generalize by saying smaller managers, but you hear these stories of managers using discretion on the names. Okay, that's something that you need to be really careful about. That kind of feeds back to is this a regulated entity or a regulated situation? That you want to be careful about. Professionalized private market actors like ourselves and others, obviously we have a lot more scrutiny and independence as it relates to the review of the valuations itself. But at its core, one of the reasons you want to go into private markets, right, is muted vol, and based on fundamentals and not the vagaries of sentiment, if you will, or what's happening with regard to flows, or if in the equity markets, if I may be so bold, what's NVIDIA doing by way of its earnings, or Meta, or, is it the Mag 7, 4, 2? I don't even know anymore, but you're getting moved around quite aggressively with just a handful of companies.
Yeah. In terms of and then just on liquidity and being able to, hey, I've invested in a private market fund and now I want to redeem or I want to pare some back. What are some of the things that investors should take into consideration?
Well, first and foremost, I think when you make the investment, one needs to understand what is the cap by way of liquidity each quarter. And most of the funds that we have seen in these evergreen formats, it's about 5% of the NAV per quarter. Yeah. And so you just need to go in eyes wide open. This is not a mutual fund, certainly not. It's not an ETF. And so as you think about the tiers of liquidity within your portfolio, there's a reason you're receiving or should be receiving some form of premium for investing in these, right? And so I would not use this as the first stop on the liquidity train, okay? Yeah. Is it liquid? To the degree that I just defined it to be, yes, it is, but you need to be eyes wide open. Now, that's not a bad thing, right? Because what you don't want to have happen is a situation where there's a run on the fund, and as the manager, you want to protect the investors from folks that just have jittery feet. And so there is a purpose as to why these 5% caps have been put into place, and it has protected investors, to a large degree. But again, I think you just need to understand that this is not a daily traded vehicle. And as you think about your liquidity tiering, work with your advisor to develop a plan that makes most sense. And I think if you do it that way and understand it to be that, you'll be just fine.
Yeah. And just to clarify the 5%, that doesn't mean an investor can only get 5% of their assets back. It means the fund keeps about 5% liquid. And if there are a lot of redemptions for whatever reason, and that sum of redemptions is greater than 5% of the total value of the fund, then there might be some proration on redemption.
That's correct. So said another way, if you had $1,000 in the fund and you were the only one that wanted to get out in a particular quarter, you would get all your money.
Right. Correct.
That's right.
Alex, how do you see the private market evolving over the next couple of years?
Sure. So I think the what I would say the already defined arena of maybe corporate lending and so forth, I think that will just continue to expand. I think there'll be more share moving into the private markets. But if you kind of think about like what's around the curve, I think, as mentioned earlier, this asset-backed finance arena, the opportunity set being as large as it is, you're going to see opportunities coming in that type of format for the first time. Many investors, I was just on with a pretty large advisor, and he was, looking forward to seeing this because he would love to invest in it, but he couldn't find a conduit or a fund or any type of, opportunity to do so. So I do think you're going to see more on that asset-backed side of the equation. I also think you're going to see enhanced opportunity sets within infrastructure. And so, those are two areas that I think if we look back 3 years from now, you're going to see those areas growing quite substantially with really interesting risk-adjusted returns. And it really has been the function of, why now? How come not before? Mm-hmm. As mentioned, at least with regard to our platform, it's taken us 15 years to build out all of these operating platforms that are generating these types of assets. Thousands of folks every day walking around, not with Apollo business cards, but other standalone company that we control business cards to develop these assets that we can then, develop and through product innovation deliver for the first time to the global wealth channel. And I think that's a pretty exciting opportunity set, particularly given our history of over 200 billion of this type of activity. We're excited to develop this in partnership with folks and bring that opportunity set to global wealth investors.
Awesome. Great. Alex, I have more questions, but I know you're busy. So we really appreciate you taking the time to talk with us and walk us through this. Anything else we should touch on that you think is something critical?
I would just say one thing on use case, because I get this a lot. How do we allocate? What should we be pulling from? I think that's critical. And I put a piece out just this week to the sales team. Many of these strategies, it's obvious. You mentioned high yield and fixed income replacement, but I'd be loath not to kind of push a little bit on equity replacement because of the concentrations within the S&P 500 that we are witnessing. More and more concentration, it seems each and every week. And then you take a step back and you want to go back to sort of capital asset pricing model in a way that's, I'm sure sends a shudder through many, but it's basically, what's the risk-free rate and how do you add risk and what premiums are you getting? So I simply put a piece out 2 days ago that said, okay, if our activities in credit, between now and the end of the year are going to deliver, let's say, another 7.5% in distributions on top of Q1. And then you look at that relative to the equity market, which has turned in 19.2%. For the equity market to provide an equivalent return, that's 16.7% for the year. But then I would argue there's probably another 400 basis points equity risk premium. So the risk-adjusted return compared to some of the credit activities that we would deliver, those equity markets would have to deliver north of 20%. And as we see the landscape with our view through Torsten Slacker, our chief economist, as no rate cuts in 24, the volatility that we have seen so far, we think that's going to be very challenging for the equity markets to deliver. And credit is a little bit more certain because of the coupons that are coming. And each month as those coupons come, you're buying down that risk and you're locking in that return. So I think there's equal conversation to, do you pull from the 40% public fixed or the 60% public equity, just to oversimplify? We think the answer is it's worth some consideration at this point in the market.
Yeah. And I, thank you for bringing up Torsten. We are both avid readers of his research and love his Daily Spark and use it all the time. So thanks for bringing it, and appreciate the Apollo research as well. Thanks so much for your time. Really appreciate it.
Alex.
Well, thank you for having me. Have a wonderful weekend and look forward to having more conversations, and the partnership is great. So thank you.
Thanks, Alex.
The RAND Group is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other data information contained in this presentation is provided as general market commentary and does not constitute investment advice. The Rand Group and Hightower Advisors LLC or any of its affiliates make no representations or warranties express or implied as to the accuracy or completeness of the information or for the statements or errors or omissions or results obtained from the use of this information. The Rand Group and Hightower Advisors LLC assume no liability for any action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purposes only. The opinions expressed herein are solely those of the author and do not represent those of Hightower Advisors LLC or any of its affiliates.